September, traditionally thought of as a weaker month for the markets. Can that make it a good time to rebalance your portfolio? Let's get more from Kachur, Senior Investment Advisor and Portfolio Manager at Wellington-Altus Private Wealth. Thanks very much indeed for coming on the show.
Yeah, thanks for having me, Andrew.
You say markets are elevated. Stocks are not cheap.
Yeah, I think if you look at historical ratios and just the aggressive move up since the downturn in April, it's hard to argue that, stocks aren't elevated. Most indexes are hitting all-time highs and seem to be, continuing to move higher, which in my experience, specifically under the Trump administration, it's like things get fairly valued and then at some point there just is this extended rally where historically anyway, markets have needed to pause and come down a little bit. So I'm not necessarily worried about the market just for an entry point on new money right now. I just think that the downside risk probably is about neutral to the upside gain in the short term. So I'm not advocating for being out of equities. I'm advocating for tried, tested, and true wealth management techniques such is rebalancing, trimming, and just taking care of your portfolio. As we all know, things don't go up forever.
One thing, one task you think this would be a good time for is rebalancing. Does that mean, for example, lightening up on some of your winning stocks?
Yeah, I think so. I mean, depending on what you hold, of course, some portfolios or all portfolios are constructed differently, but for example, if you've been heavy into, let's say the chip sector and NVIDIA and, you're overweight into some companies that have really moved, even like a Palantir, for example, those types of things, they're volatile names and, 10, 15, 20% corrections on those aren't, out of the ordinary. So again, in my experience, I've always felt that buying is the easiest part, but selling becomes difficult for people just because they have fear of missing out and they don't want to, leave money on the table. But again, there's always going to be opportunities to buy, whether it's the stock you owned or other stocks that have underperformed or have a better entry point. So to me, it's just all about keeping perspective and knowing that, there's a lot of good priced in right now. And if some of that good doesn't happen, then, markets are going to be potentially coming back.
But you do think that the AI stocks and tech darlings have a good chance of leading the market higher?
I do, yeah. So really for the last number of years, my portfolios have been more derived out of US-based companies, specifically with weighting towards technology. And I do think that that's going to continue. I mean, we might see some, minor slips where money's moving to the Dow or moving to small caps or some of these other areas. But by and large, I think the mega cap techs and then, the AI kind of themes such as chips and servers and all these types of things, I think they're going to continue to lead. And, that would still be my preference for investing new money, just maybe at, a slightly better entry point than what I'm seeing on some names right now.
When you talk to clients, do you get a bit of a fear of missing out vibe?
Yeah, a little bit. Yeah, it's a little bit of, I've got some new money. Where are we going to put it to get the best returns? And again, historically, in 15 years of experience, once you start hearing more of that, I just feel like the market's getting a little bit long in the tooth. So again, there's a lot of good companies out there. And so to me, it's just about risk management, specifically coming off of now, a great year in 23, a great year in 24, and a pretty good year so far in 25. Markets do move in cycles, and at some point in 25 or most likely 26 or 27, we're going to see a not great year, and it just is no good if you see all your gains dissipate because you were too aggressive in the later stages of a rally.
It's interesting, isn't it? I mean, the market has done pretty well this year. It soared last year in 2023. I'm thinking in particular about the S&P 500. hasn't been such a gangbusters year. I mean, America's up about 9%. But how do you think the end of the year is likely to play out? Do you think people will try to lock in gains?
Like our charting, which, we've been pretty on point with it. Like our interim high for the S&P was 6,600. And so as we're kind of getting closer to that, that's where I'm, believing that the trim should start to happen. We could see as high as, I think, 7,000 or, maybe even as high as 7,400 on the S&P if everything goes really well. And probably not into the end of the year, but maybe into the first few months of next year. So like I said, I still think that there's upside opportunity. But again, there's a lot of good priced in with rate cuts and, geopolitical and more. And, there's always a million things going on. And specifically with Trump in office, the dynamic of investing can change pretty quick. So again, I think it's just about asset allocation and portfolio management. And as long as you have the proper asset allocation, you can stay in, equities that are appropriate for you. Just once you go on 2 or 3 good years without rebalancing properly, maybe a 65% equity holder is up to, 85 or 90. And then, the down starts to hurt a little bit more even when it comes.
Cole, thank you very much indeed for joining us.
I appreciate the time. Thank you.
Cole Kachur, Senior Investment Advisor and Portfolio Manager at Wellington-Altus Private Wealth.